Well, hello there, ladies and gents. Great to see you again. And welcome back to Wisdom and Wealth Pathways to a Life of Significance for you and your family. Ryan Ruff here, your moderator. But as always, I'll be joined by Frank Astorino, the star of our show, president and CEO of the Astorino Financial Group. We're going to be jumping into another wealth management related discussion, as we typically do here on the podcast. And today, we've got a really great episode teed up for everybody. We've got a guest joining us. He took the trip over to the Astorino Financial Group today to record in person with us. Today, joining us, we have Garrett D'Alessandro, the CEO of Archlight Wealth Management. Really excited to be welcoming Garrett onto the show today, as you know, and as we sit down and have today's conversation, just a few days following the inauguration of President Trump. There's a lot of questions, a lot of concerns surrounding so many folks across a various, slew of wealth management topics. So with the combined, expertise and experience between both Garrett and Frank, we're going to be diving into a lot of concerns and considerations today. So really excited to welcome on Garrett. So first, let's go ahead and say hi to the guys before we get into the nitty gritty of today's discussion. Frank, Garrett, great to see you guys. How are we doing today?
Great to see you, Ryan. As always, we love your interviews, and I think this is particularly timely. And Garrett has a lot of thought on what's going on.
Yeah, absolutely. And Garrett, appreciate you carving some time out of your busy schedule to be with us. And Frank, before we jump into all the details and all the good stuff today, why is it that you wanted to have Garrett over to the show today?
It's not usual to have more than a 3-decade professional relationship with someone, and Garrett's vision and in practice how he approaches high net worth and affluent families and businesses is akin to what I would do for myself and have. And I really think that it's stood the test of time. We've had a real successful retention rate, and our clients, love the journey, and I'm looking forward to continuing it.
Fantastic. Well, hey guys, let's jump right into it. As I mentioned, we are sitting down recording today's episode just a few days following the inauguration of President Trump. A lot of questions in a lot of folks' mind. Let's start from a high level. Garrett, maybe you can tee things off for us, and that is, what's kind of your forecast outlook for the U.S. economy here in 2025?
Ryan, we have been positive on the U.S. economy for the past couple years. And as we look ahead in 2025, we remain optimistic and confident that the U.S. economy, despite all of the issues that we'll experience and probably talk about during this interview, will remain in a growth trajectory, roughly 2.5%, which is good and solid for the size of the U.S. economy. And I'll highlight 3 points. So the consumer is in good shape, and the consumer represents roughly 65% of the total economy, and they have real wage increases. They have good savings rates. They obviously feel good in terms of the housing market. The value of houses is up. There are some concerns there. Obviously, the uncertainty of the political environment is making some consumers rethink some of their behavior. Interest rates, we still want them to come down a little bit more. But overall, the consumer is in a pretty good space. In addition to the consumer, you have businesses, and we call that business investment. And they're spending very nicely, roughly 4% growth rates on technology and artificial intelligence and science and building and plant and equipment. So the businesses or the investment that they're making in the economy is, again, relatively solid and strong. The housing market is another category of investment, and interest rates came down a little bit. If they can come down a little bit more, that will give a little bit better push to that side of the investment side. And then the third part of the economy is the government. And we're going to talk a fair amount about the government. You have mixed signals there. Some things look okay, and some things are very uncertain, things that we'll talk about in terms of tariff and immigration and other things. So to put a summary together, good, solid overall U.S. economy, roughly 2.5% GDP growth, and inflation should be trending slightly down into the 2.5% to 3% category.
I like it. Well, I appreciate kind of the overview to get us started. Let's kind of drill a little deeper now into your outlook on kind of the fiscal policy under the new administration that's taken office. What are some of the key items that you and your team are focused on these days?
So when you think about what the new administration has to do or wants to do, the first thing that we want to highlight is no one knows. And I would offer a suggestion that not even the administration knows really what they're going to do in specific and when and to what magnitude are they going to do things like tariffs, immigration, tax cuts, regulatory. So those are the four big campaign communications. And I'll just give you an overview that two of them could be relatively positive. And let me give you an example. If the government, the new administration, reduces taxes, clearly that's a positive, whether it's reduced taxes for the consumer or reduced taxes for businesses, that would be a positive. Another positive would be what they call the regulatory expenses and the regulatory procedures. If they make it a little bit easier for businesses and for consumers to do those things that they enjoy, spend, borrow, invest, that will be positive. Now, offsetting those are the real big uncertainties, which are tariffs. And I'm going to use tariffs. It's kind of like a sales tax. And you're going to have higher costs for things. And clearly that's not going to be good for the economy. And the other thing, obviously, is individuals and immigration and how that influences the labor market probably is a negative.
I like it. So thanks for carving out kind of that outlook on the fiscal policy side of things. Let's go a little deeper now into this idea of tariffs. It's been a kind of a buzzword, if you will, that we've been hearing throughout, President Trump's campaign and now just here in the first few days of office. With tariffs, they could provide kind of an upward pressure, if you will, towards inflation. Potential labor markets could shift as a result, and there's another wild card there to be watching. But when you add it all up there, Garrett, what is ALW's kind of outlook for inflation specifically?
So think of inflation as dependent upon where you're spending your money. So if we're spending our money on services and those services have 2% inflation versus if we're spending our money on goods that are being imported that are going to have higher prices because of the tariffs. So I don't want to say it's a tale of two different inflation rates, but I think that's a good way to think about it. Many of the services and many of the domestic-oriented things that we spend our money on will not be affected by the tariff, and that will remain good in terms of inflation, call it 2%, 3%. Things that we spend our money on that are going to have a tariff, sales tax, could go up 3, 4, 5, 6%. That's not what the consumer wants to see. So the blend could be 2.5% to 3%, depending upon the basket of goods and services that someone spends their money on. And I would add that the psychology, people see that the prices of certain things are going up. It might slow their spending on the other things. So there's this substitution effect. But the real inflation rate, if they don't go overboard with the tariffs, should be in the 2 to 3% category throughout the year. And I'm just going to add that wages, the amount of my salary and income, is expected to go up about 3 to 4%. And as long as what I earn is going up a little bit more than what all of my costs are, I'm in a good spending consumer state of mind.
I like what I'm hearing there, Garrett. So I want to kind of shift now our focus towards a topic that usually generates just so much interest surrounding investments in the stock market at large. So, given your outlook on what we're hearing and expectations for the stock market, I mean, we're coming off 2 consecutive years of kind of 20+% returns. What do you think the kind of landscape in the future really is of the stock market here in 2025? And then kind of a secondary question, if you will, what are you looking at in terms of just the near term for the market?
Mhm. We've had two very strong years of returns in what we call the S&P, which is kind of the blue chip stocks, and technology stocks in particular, that is called the NASDAQ. We expect the stock market, whether it's the S&P or NASDAQ, to go up this year, so it's a positive. And we think somewhere around 5 to 8%, which is a reasonable. It's lower, obviously, than the expectation over the long term of 10, but 5 to 8, when you add it with the 20% plus and the 20% plus, is really a pretty good outcome. And why we think that the market will go up is because the amount of earnings that the S&P companies and the NASDAQ technology companies, their earnings per share, their revenue, is going to set a record in the history of those companies. Almost all of those stock markets in aggregate are going to achieve higher revenues and higher profits than they have over the prior years. And that is the fundamental foundation for why stocks should have a positive experience. I would say that the US is in this exceptional level of profitability and growth relative to almost any other region around the world, whether it's Europe, Asia, Latin America. We feel more confident and we feel more assured of keeping our equity investments focused on the United States companies.
Well, and speaking of kind of United States companies, a lot of this conversation is surrounding public equities. Any thoughts on the private side of things with regard to equities?
So one of the great things about the US economy and the US stock market is what we call innovation, whether it's technology innovation, science innovation, social innovation. Aspects of innovation start with small companies, the iconic two people in the garage in this country. Those are private businesses. And because we as a country foster innovation and invention and research and development and entrepreneurialism, the amount of companies that are private has zoomed up over the last several years, and it's now about 10,000 private companies, and the public companies represent about 6,000. So it's an interesting situation where there are more private companies than there are public companies. So that crossover means for certain situations and certain clients, you might want to invest in the private side of those 10,000 companies, always keeping the bulk of your money in those blue chip 6,000 public companies. And if I could, things like suitability and volatility and liquidity, that all is very important and necessary to understand if you're considering private companies. But if you were to think about the portfolio, if over the long run, the blue chip public companies are going to generate 8 to 10%, the private companies, because of they're smaller, they're innovative, they're in emerging businesses, they're faster growth, they're going to generate a better return, or we expect them to generate a better return. And that expectation is based on historical experiences over the last 5, 10, 15 years. Private, fast-growing, innovative companies have generated a better return than the public companies.
All right, I appreciate you peeling back the curtain there, and yeah, certainly beneficial to keep both in your considerations as you're working through your investment portfolio. I want to shift our focus now towards bonds. Fixed income investors, Garrett, have pretty good interest rates these days. What areas of fixed income really look attractive, and how does kind of alternatives such as private credit really fit into client portfolios these days?
So one of the things we at Archlight Wealth Management are really pleased about is the opportunity to earn 5%, 5.5%, maybe 6% in blue chip bonds. Another word for blue chip is investment grade bonds. Those bonds are rock solid. They're reliable, they're predictable. And as we talked about before, if you think of inflation in that 2.5, maybe 3, depending upon the basket of goods that you spend money on, if you're earning 5 and your inflation is 2.5 or 3, you have a real return gap there, which is very attractive, and that is favorable. So we like investment grade public bonds. When you think of all of those companies that we talked about, those private companies, there are lots of really good private companies. Some of those private companies have equity as the source of their ability to innovate and invest and do research and development. And some of those companies prefer to have private borrowing rather than private equity. And the private borrowing depends upon the industry and the size of the company and the characteristics of the balance sheet can, depending upon the particular type of approach, generate returns that historically, if you look back 3 years, 5 years, 10 years, the private bonds have generated better returns than the investment grade public bonds. And again, depending upon suitability, liquidity, tolerance for transparency, that's a category that has become more available to select accredited and qualified clients that you might want to consider as a high net worth client in your portfolio.
Garrett, this is all super helpful information. I appreciate all your your wisdom and guidance here today. As you know, for many of our listeners here on Wisdom and Wealth, Frank and I, we have a lot of conversations surrounding strategies, solutions, approaches, you name it, for those that are successful business owners, their families, high net worth individuals as a whole. I want to kind of shift our focus on the next question here towards those folks, and kind of also couple it with our tariffs discussion from earlier. How is it that you're viewing tariffs impacting, yes, the economy, inflation, but also the investments and specifically related to those high net worth folks that we talk so much about here on the show?
The notion of a tariff, let me see if I can, the premise or the basis for why would you do a tariff, there are 2 or 3 points. One, they want to stop unfair trading between 2 countries, right? So you don't, as a country, want unfair trade practices. If they're doing things that aren't fair to the United States, we have to generally either use diplomatic means or we put a tariff. A tariff is kind of like a tax. If you're doing something that we don't want you to do, we want to tax that so you stop doing it or you do less of it. That's one premise. Another premise is to cause revenues to come into our country, right? If you're collecting tariffs, if you're collecting taxes, you get revenue. And the third premise is we want to create lots of the marching order or the rallying thing is we want to create lots of manufacturing jobs. We want to get lots of blue chip, blue collar manufacturing jobs. Let me address each one of those premises. Number one, unfair trading practices is a good use of a tariff. But think of a scalpel with a very fine incision is the real only way to use a tariff when you're doing fair trading practices. If we're trading with our great countries in Canada and Mexico, and 85 or 90% of all the trade is fair, you don't want to take a hammer to one little aspect or one type of, okay, that's number one. Number two, in terms of revenue, it's not going to have any real revenue impact. Our economy is almost $30 trillion. The amount that we're going to collect on tariffs is very, very small. So it's not going to achieve more revenue in any noticeable way. And then the third premise, which this is proven time and time again, you're not going to create millions of jobs when you put tariffs on things. And the reason is those jobs need lots of people that want to do those jobs. And this country doesn't have the supply of labor or the characteristics to want to do those jobs anymore. That doesn't mean that there might not be 100,000 jobs or 20,000 jobs or 50,000 jobs. Yes, you can always point to some successes, but that's going to come at a very big cost because all of the goods that all tariffs apply to is going to cost all consumers lots of money. So on balance, I think the magnitude of the tariff, the goods and services it applies to are going to be very, very important. And if I were to guide the conversation, I would say use a scalpel, keep it very narrowly focused, and don't overdo it, because now I'm going to give you the bad news. If you significantly overdo the tariffs, what I mean by that is you're punitive against our partner in Mexico, and you're punitive against our partner in Canada, and you're punitive against our partner in China, they will retaliate meaningfully, materially, and that will actually cause us to lose jobs, and you'll end up going backwards because of the retaliation, and it will wipe out any of the modest benefits that I articulated tariffs could cause.
Sure. These are great considerations, Garrett. I appreciate you kind of setting the scene on, on tariffs at large, if you will. Kind of double clicking one layer deeper though. You mentioned Mexico, you mentioned Canada. Talk through a little bit of some of the markets of the economy that might be impacted by these tariffs, and how stocks might initially react to some of those as well.
So the objective, and I'm speculating here, I don't have any, is the US. So we used to hear about something called NAFTA, the North American Free Trade Act. That was updated, and it's now called the US Mexico Canada Trade Act. That is coming up for renegotiation next year in the middle of 2026. I'm not a negotiator, but if you start, making all of these threatening sounds to our partners in Canada and Mexico, the performance, it's kind of like a performance. You're trying to scare your partner into negotiating something a year from now, is part of the purpose of talking up about these tariffs on Canada and Mexico. There are other motivations, immigration that the administration might want to slow down, or there are drug flows coming in. So there are motivations for why they're talking about these tariffs. And I'm hopeful that the tariffs will be very narrow, will be very specific. They won't overdo them. And our partners in Mexico and Canada that ship lots of manufacturing parts, auto, textiles, footwear, phone components. You don't, in my view, you don't want to be taxing those because, one, they're good at producing those things. We're not. They're going to have to charge us more, and then all of those consumer goods are going to go up in prices, and you're going to have a retaliation. So in my view, I think they can do all of the debating before this big negotiation, but I think hopefully cooler heads will prevail, and the implications of this will be settled at modest inflationary pressures.
Sounds good there, Garrett, and we'll certainly be keeping our eyes on that, folks. As we're kind of bringing our conversation to a head today, one of the final questions I have for really the both of you, there's a lot of uncertainty in the world today, and it leaves a ripple effect, of course, on the economy, how we react to things. Just you pick, you name it. What are your respective, big concerns on the economy that you're on the lookout for?
The the retaliation potential, and I'm now talking about a low probability, but if they put the 25 and 50 and 60% tariffs on Mexico and China, they're going to retaliate at those very high levels. It will absolutely cause more goods and services that are putting tariffs on to cost more. We're going to have less of those goods. I'm not going to say we're going to have shortages, but we're going to have less of those goods. It'll dampen the enthusiasm of the consumer. They have to spend more and they have less choice to buy things. The exporters, the companies that make things that we ship to Canada, Mexico, and China, will have to cut jobs because they're doing less of that. So a big tariff applied like a hammer, without regard to the kind of the multiplier effects or the ramifications, is by far our number one concern. And I want to go back to the initial point. We have a good consumer. They're getting real wages. We have great corporate profits. They're growing. They're innovating. We, the United States, we're in an exceptional era of AI and large language models and computer. We're leading the world in innovation and research. The government spending is the second concern. Put things in perspective. They're spending 6% more than the income that they take in, and that's a whopping big number. It's $1.9 trillion. That's not appropriate over the long term, and it's not sustainable. So my second big concern is the US economy is really, really doing solid. The government spending is too much, and the tariffs run a risk. And those two, I'd like to kind of put in a little bit of a bottle, put the cap on it, and say, let us in the free market, businesses and consumers, do our thing that we're good at, and don't mess up what is otherwise a really solid outlook for the rest of the economy.
I appreciate you sharing that. Frank, any thoughts on this? Any specific concern that you've got your eyes kind of set on for the year to come?
As I'm listening to Garrett, it reinforces why we've been working so long together. He mentioned about the consumer being a big indicator, like 65% of what's going to happen in the economy. The consumer comes into this office, albeit they're affluent and high net worth, but some of their children are not so affluent yet, and they're concerned about their next generation. So the way we deal with uncertainty is on a mechanical level, we look at what things we can control and can't control. The things we can control with Garrett's team is allocation of their assets, the volatility of their assets, the tax impact of their assets. But the things that we can't control, we test for those things. So that's where liquidity comes in and what's your station in life. So one of the reasons they stand out is we've always taken the wholeness of that consumer to prepare them for any situation. The leading behavioral finance professor, Meyer Statman, said it basically comes down to two things in people. They want prosperity. They want to make more money than they have, and we can design that. They also want protection. They don't want to lose what they have. So that's why we're synergistic. We align on what the individual micro level need is with the macro, and the macro is sometimes out of our control. So when it comes to the government, and I've had some exposure to that, I do think if we go for parity, Not everything is equal or fair, but as long as we're logicking our way through these solutions on the national debt and so forth, and it's not for just political reasons, it's for the economic good of a large number of people. And we've been successful doing that together, so that's why the relationship continues.
Sure. I love it. Frank, we've thrown a lot at our audience today, a lot of considerations surrounding the economy at large, given, the new administration, as well as just different, habits and different avenues of possibility really for the year to come. For anybody out there with deeper questions that, they could really benefit from kind of opening up a dialogue with you or your team, Frank, what's the best way somebody could reach out to you guys and just start that conversation about their own unique situation?
I think there's no pressure for them to look at our website, www.astrinofinancialgroup.com. Garrett has a website in process, I believe, and that'll also be introduced. But I also think we have a very non-threatening discovery process. So if they make an appointment with Karen or Vicky, we'd like to, see where the fit is, and they should just call on our number and get in touch.
Fantastic. Well, gentlemen, I appreciate you both carving some time out of your respective busy schedules to jump on here today, talk through the outlook for the economy here in 2025, and looking forward to seeing you guys again sometime soon here.
Thank you, Ryan. Always a pleasure.
Thank you, Ryan.
Appreciate it. And hey, folks, look, we want to take a final moment, as we always do on this show, and thank you for making us a part of your day. If you enjoyed today's discussion, if you learned a thing or two, make sure you hit that subscribe button on whichever platform you checked us out on today so that you don't miss out on future conversations where Frank and I dive into different wealth management sectors, or we bring on a great guest from Frank's esteemed network. Of course, Garrett D'Alessandro joining us today. We've got another episode teed up with Garrett that we're excited to be bringing you guys here in the coming weeks, so stay tuned for that one. But look, for Garrett and Frank, I'm Ryan. We're going to go ahead and say so long now, but we appreciate you stopping by and being with us today on Wisdom and Wealth.